Good afternoon, everyone, and welcome to the first installment of what we are going to plan to have an ongoing webinar series, which are going to focus on analyzing trading activity within hedging programs across the industry. For those of whom we've not formally met before, my name is Frank Fiorilli, and I co-run the loan level hedging advisory business for our bank clients here at Durda Path. I'm joined by my colleague, Isaac Wheeler, who is the head of balance sheet strategy at our firm. So for today, we've allotted 30 minutes for this webinar, hopefully a quick window for you all during your day. And we're going to aim to maximize the delivery of content and data analysis for your consumption. And so with that, we're going to hop right into it, and I'll pass it off to Isaac for the ALM portion of the discussion.
Great. Thanks, Frank. I think we've talked about this before on previous webinars, but we always like to start by talking about what we've seen in recent earnings calls. We like that for a couple of reasons. One is, it's a great place to look at what other peer banks are executing. Even if you're not a publicly traded bank, even if you're a credit union, these are great examples or great insights into what other institutions are doing currently on the ALM front. So got a couple selections here from recent earnings calls. We're obviously still working our way through Q2, so we haven't finalized kind of the total look at that. But so far, we've had a couple interesting anecdotes. This first one is from Citizens Bank talking about how they're continuing to leg into downside rate protection, talking about how right now they think that those hedges are generally north of where they think the Fed will come out. We've also got a quote here from Cadence talking about a $550 million interest rate swap they executed to reduce the interest rate volatility associated with some securities they've acquired as part of a recent acquisition. And last but not least, we've got a quote here that relates to kind of customer hedging. And I know, Frank, you're going to get into this in a little bit more detail. I think that overall, I think the takeaways on our side are that these banks and large continue to be very mixed in terms of what they're doing. Asset-sensitive banks continue to leg into those trades, still see some hedging against rising rates. Though, as you can see here on the right side of our screen, we've seen a better mix than maybe we did back in 2023. So I've seen a lot of two-way flow still. The other thing I'd highlight is that I think what's interesting about that Citizens quote is that these banks, Citizens in particular, but many, many other institutions that are asset sensitive and have been programmatically executing these strategies, they have to date not really seen the benefit of that. That's really been a little bit of a drag on earnings. These trades are generally those that, since curve is inverted and the Fed doesn't really follow through on the rate hikes that the market's been anticipating, these are strategies that have cost those banks a little bit in terms of earnings. I think you're going to start to see a lot of, I wouldn't say victory laps, but a lot of kind of celebration of those strategies now that we look like we're about to head into another rate cutting cycle potentially. In addition, kind of the other thing I'd highlight about that Cadence strategy is, we're seeing more and more conversations and seeing more strategies executed around big kind of capital markets transactions. So whether it's in an M&A deal, hedging the securities portfolio that is a part of that, or other transactions, big loan sales, things like that, we're seeing kind of pay-fixed swaps, payer swaptions being talked about and executed more frequently. We look back to the couple years, last couple quarters, a couple trends that we see on the ALM side. I mean, one of them is that we see a persistent move lower in average hedge term. And we've had some new people join the team recently here, some new analysts, and we were having a conversation about this average tenor. And an analyst asked me, is this because banks are feeling less confident than they maybe did before about their hedges? And I thought that was an interesting insight. If you think about what the longest average tenor we've ever seen on ALM, it probably was back in 2020, and it was probably a pay-fixed swap that a bank executed. In 2020, we might have even seen an average tenor close to 7 years. And that's not necessarily because those bank balance sheets required a 7-year hedge. I think it's because it was very easy to have conviction about a rising rate strategy when we were pinned at zero. And so I think, yes, in part, this trend lower in average tenor has something to do with confidence. A lot of two-way flow, like we said, a lot of uncertainty. We can make a case for rising or falling rates, as we said many times. And so I do think that that's a big factor behind that decrease in tenor. I think the other reality too, though, is that it's not just confidence in the hedging strategy, but a lot of our clients have, I think, sort of a mixed bag from a rate risk profile standpoint currently. They're not 100% confident in how their balance sheet will respond and earnings will respond and or move higher or move lower. And some banks would say that they could make a compelling case for seeing margin compression in both directions. And so I think that's the other driver. You just see an average tenor going down as banks have less confidence, not necessarily in the hedges, but in their own profiles. The other interesting thing we looked at was, and this is the first time we've done this, is to look at, well, on day one, when you execute a hedge, you have some sort of income statement impact. That's one of the artifacts or results of hedge accounting, is that unlike a mark-to-market trade, pay-fixed swaps, for example, are truly accretive to earnings in the short term. That's something that hedge accounting creates for our clients. And if we look at all the strategies executed across our client base, you've seen over the last few years, persistently, the average day one income statement impact of a strategy executed has been accretive. So on average, banks are doing things that are additive to earnings in the short term. Maybe a bit of a paradox to those that are evaluating hedging programs for the first time. Insurance is something you pay for, not in bank ALM world for the last few years. These hedges have paid the banks. However, more recently, going back to Q4 of last year and in the last couple of quarters, we're seeing a bit of a change. So Q4 24 was the first time in several years that we saw an average trade being a negative trade or actually being an expense to banks. And I take this as a positive. I mean, certainly part of it was that the Fed cut rates and pay-fixed swaps are less accretive to income than they used to be. Part of it was that 5-year part of the curve hit kind of a multi-year high at the end of 2024. But also, I think part of it is that we've seen a move towards option strategies and a little bit more diversity in terms of hedge direction. So now that we're no longer just seeing pay-fixed swaps, we see more clients doing strategies that are going to reduce earnings marginally. I think the other thing I'd add too is that we're seeing, I think, margins bounce back a little bit, particularly among liability-sensitive banks. So banks have more earnings to spend on hedging strategies. They're not quite as constrained as they once were in terms of hedge budget. And I see this as a very healthy development, something that's more normal, something that I think we might expect in a more normal market environment. So that's a nice change to see, and I think reflects a bunch of different things that have gone on in our industry the last few quarters. The other things we looked at were a breakdown between hedging higher rates and hedging lower rates. So you go back to 2023, a huge amount of our hedges that we executed were those that protected against rising rates. No surprise there, right? We had a very inverted curve, and the advent of the banking crisis and the immediate aftermath of that. A lot of the banks that felt compelled to hedge were those that were liability sensitive, that fit the profile of those institutions that did fail. So that doesn't surprise me that we saw such a huge majority of those strategies being those that protected against higher rates. I think you're starting to see more and more participation from asset-sensitive banks that's bringing the lower rates hedging percentage higher. Year to date, it looks like that's been 20%. I would expect that we end the year closer to 30%. So just getting more and more close to that 50-50 split that you might otherwise anticipate. In addition, we looked at kind of the breakdown between options and swaps. A lot of advisors, us included, have talked about how institutions are starting to see value in optionality. If you're exposed to both rising and falling rates, it follows that the best hedge for you is going to be something that's in the options space. And that's what I think we're starting to observe. Banks are doing more and more option strategies, floors, collars, caps, things that are not just your vanilla pay fixed, receive fixed swaps. So with that, we wanted to touch on maybe 2 quick strategies that we think are topical in this environment, 2 strategies that have been very popular with our client base. One of them is a costless collar. And we sent out a piece about this a couple of weeks ago. And really what this strategy is about is taking advantage of some interesting pricing that exists in the market currently. Options markets, if you're going kind of academically by the book, a 100 basis point out of the money and a 100 basis point out of the money cap and a 100 basis point out of the money floor, it costs about the same. They should have roughly the same premiums. Now, in reality, that's not true, and that gives rise to this thing that we call skew. And the feature of the market currently is that the market is pricing in a substantial premium to floors versus caps. And so if you're a bank that's exposed to rising rates, I'm sure you can execute a pay fixed swap and mitigate your risk to rising rates that way. But what the options market offers you is an opportunity to do it in a collar and in a way that gives you actually a pretty nice buffer to reprice on the way down before you start making payments to a dealer. So in this example, take an example, $1 billion bank that's liability sensitive, maybe in an up 300 shift, they lose 15% of net interest income. In a down 300 basis point shift, they gain 4% in net interest income. So kind of a negatively convex profile that I know a lot of banks have. A costless collar does a nice job at starting to flatten out that profile. You reduce the risk in that up 300 scenario by almost 2/3, and you really only have to give up a little bit of your performance in the down rate scenario to pay for it. So I think that's an interesting strategy and one we've seen kind of get a lot of sponsorship and a lot of activity for this last quarter. The other strategy we wanted to quickly touch on is that of a purchased floor. So very, I think, pretty easy to understand strategy, maybe a little bit simpler than costless collars. But floors have been popular for a couple reasons. One of them is that the negative carry of the simplest downside hedge, receive fixed swap, is pretty substantial. I think as we sit here today, if you want to receive fixed, you're going to give up 80 basis points of yield on any floating assets you term out to fixed for a 5-year period, for example. And the reality is that an interest rate floor struck around 3% or even below 3% is going to have a premium expense that is much, much smaller than the negative carry of a swap. So if an institution comes to us and says, well, I want the most earnings efficient way to protect against lower rates, an interest rate floor is oftentimes going to be where we end up. I think also, again, in this example here, we're talking about a $5 billion bank that's asset sensitive, another negatively convex profile where they lose more in lower rates than they make in higher rates. That's the other reason why I think we've seen real adoption of floors is that most asset sensitive institutions, even though they might see a lot of exposure to declining rates, don't expect to benefit from rising rates and probably didn't see that this last cycle. So floors have been attractive for that reason as well. With that, I think we want to keep things kind of punchy here and make sure we're being efficient with our time. So Frank, I'll go ahead and turn it over to you.
Perfect. Appreciate it, Isaac. And so, we're going to pivot now to the loan level world of bank hedging programs for the next, call it 10 to 15 minutes, and we'll get you all out of here. And so just to set the stage, the data presented within the next 5 slides is based on loan level activity across our entire client base, which comprises anywhere from 130 to 140 banks around the country. And so as we look at this first slide here, what we're analyzing is the average notionals and terms over the past 2.5 years. And so looking at that top chart there, looking at the average notionals traded over the past 2.5 years. And from here, you can see it's been relatively steady over the past 3 quarters, roughly in the $6 million to $10 million range. And I think over the couple of year trend, we've seen a steady increase in deal size. I think it's probably a little bit tough to pinpoint the driver there, but assume it's some combination of the lending environment, specifically within commercial real estate, improving over the past few quarters and improved levels of dry powder at these banks following what I'm sure a lot of you have been doing, the successful deposit gathering activities throughout last year. Additionally, we're starting to see the dust settle from the SVB and Signature fallout, which has led to recovery in the syndication market. So again, trending deals larger in size. Going down to the chart at the bottom there, looking at the average duration. And as you can see, we still remain on the shorter end of the spectrum compared to historical standards. And when I say historical standards, if we were looking at this chart prior to 2023, 7 to 10 years was really the average for the trades being executed. I think as most folks are aware on this call, a lot of that is driven by the uncertainty remaining at elevated levels, right? You have customers who are coming in preferring shorter term rates, not wanting to be locked into a 10-year fixed rate. And so by far and away, the most popular setup we've seen over the past 12 to 18 months has been pairing a shorter term swap, whether that be 3 or 5 year swap with a longer term loan, call it 10 years. So that continues to be a very popular trade. And I think, still in general, probably a ways out from duration extending again. I think, in my humble opinion, when the Fed is done or near done cutting by the market's perception, we'll start to see borrowers get a little bit more comfortable with 7 and 10 year fixed rates again. I think, for better or for worse, because it's not as if the Fed cutting is going to drive down term rates. It's almost more of a psychological issue with bank customers than anything else. And so, even so, I'd go one step further. I'd say by this time next year, Fed will be done or close to being done cutting, and I would venture to guess that term rates are still going to be at the same levels they are today, or even higher than they are today. So having those conversations with the customer, making sure they understand these dynamics is definitely very important. But back to the data, onto the next slide here. What we're going to be analyzing is, for one, we're going to dive into the average markup or fee income earned on new swap loans. And so as you see here in the top chart, continue to see 25 to 30 basis points as the range on average. I think it goes without saying, but it's a very deal dependent data point. I mean, you have increased competition, size, experience of the customer will certainly influence the revenue figure on any given swap. But if anything, I'd say as we've seen duration shorten a little bit, I've actually seen a lot of banks elect to try and trend a bit higher towards that 30 basis point range as a way to almost compensate for that smaller DV01. And so I think additionally, the daily volatility that we've seen has actually presented some opportunities to drive a little bit more fee income as well. So, you know, as an example, on a day where it's volatile, rates are down 7-8 basis points, I've seen banks go in and look to, you know, take an extra 1 to 2 basis points for the bank and pass along that 5 to 6 to the customer. So that's one strategy we've seen some banks do. I think now pivoting to the bottom part of that chart, it's probably the most requested data point that I get is where are we seeing banks price their spreads on these deals? And so I will say, as a reminder, these metrics are based on executed deals and they represent the spreads over SOFR on the loans. And so for the avoidance of doubt, these spreads do not include the fee income basis points that I just previously talked about. And so I think over the past few quarters, what we've seen is a slow burn to more aggressive pricing to where we currently sit in the 2.25 to 2.5 basis point range. I think certainly competition has been increasing into when banks have needed to get a bit tighter. There's also this dynamic sometimes where loans that were executed 5 to 10 years ago are coming due, and with rates being much higher in this environment, there needs to be some sort of tightening just to make the deal work. So in general, I think we're still ways off from where we were 3 years ago when it was a regular occurrence to see spreads dip below 2%. But if you were to tell me that over the course of the next few quarters, we see the average spreads decline to 210 to 220, I could absolutely see that. So with our next slide, it's kind of taking that spread analysis to the next level, if you will. And so here we have an analysis of the spreads broken down and color coded across geographies. Another quick tidbit just to understand this chart, these figures are based on bank headquarters, not necessarily which state the deal is being closed in. And I'm sure as everyone looks here at first glance, most of you folks are saying the same thing. How do I start lending in Louisiana? As you can see here, the spreads of deals done in the state are often in excess of 3%, which is just fantastic and fascinating at the same time to see. On the other end of the spectrum, we've observed the tightest spreads in Pennsylvania, where it's become a regular occurrence to see sub 2% spreads, which is extremely tight. But I think in general, it's typical to find the tightest spreads in the metro areas where competition is high. You know, Boston, DC, LA are all areas that are top of mind. And I think in those areas, in line with tighter spreads, it's not uncommon to see fee income levels contract to 15 to 20 basis points in those markets as well. And so last point here in the bottom chart, we've broken that data down into regions and bucketed the most to least aggressive spread ranges. And so as you can see here, I think generally themes we get out the West and the Northeast are probably seeing the tightest overall ranges of deals. And so with that, I'm going to move into the final two slides here. And so what we wanted to do is take a deeper dive into the trade volume and revenue figures of our bank clients. And so what we've done here is we've bucketed them by asset size. And in this first slide here, we're looking at banks sub 10 billion. And so quick description of the data pool is, again, from our bank clients sub 10 billion. And the two sections here detail the median peer and top peer based on net revenue earned in their respective programs. So first point I'd make, looking at the median peer, right off the bat, it it doesn't take much to have a worthwhile program, right? 5 to 10 deals, and in environments where duration is longer, you have the ability to tick up near the 1 million mark in net revenue. And I'd say for these smaller banks that are doing a handful of deals annually, it is most likely being reactive in nature. So I'd say there definitely exists further opportunity there to really build out these programs by further mining the existing loan portfolio or getting creative with the strategies you're offering to your clients. And then looking on the right side here to the top tier in this contingent, this is a bank that's put strong rails in place to govern their program. I mean, simply put, any deal over a specific size and tenor, they're going to lead with the swap product. And probably more importantly than that, they're pricing the swap option at a more attractive level than an on-balance sheet offering for the same deal. And one other item I'd mention here with this high performer is that, as you can see, the average term is 3.7 years. So this is a bank that is successfully utilizing the shorter term swap with longer term loan approach that I mentioned earlier to accommodate borrower rate concerns. But in both cases, I would fully expect the charts at the bottom to trend higher when we have these webinars in the future. I think it goes without question that swap adoption in this space continues to grow, and rightfully so, given the benefits. So I would expect just, again, the absolute levels of these revenues and volumes to trend higher over the course of the next 1 to 2 years. And so with that, we'll head into our last slide of the session. And what we're doing is we're looking at the same data, but banks with assets greater than $10 billion. And so as you see here, as we scale larger, we find banks with more consistent volume and revenue within their programs on an annual basis. With a larger balance sheet, they have the benefit of being able to average closer to the bigger end of that scale of the average notional schedules, the average notional traded that we discussed earlier. And for the top performers in this category, we find revenues that track closer to what we used to have as the old rule of thumb with loan level hedging programs, which is for every 1 billion in assets, earning about 1 million in swap fee income annually is a good measure of success. And so I would expect that, again, over time, over the next 18 to 24 months, as duration slowly starts to extend and banks become more and more familiar with these different strategies within their hedging programs, we'll start to see these numbers grow, in my opinion, which should be exponentially over the next 2 to 3 years. And so with that, obviously appreciate everyone's time today. This is going to be the conclusion of the session. I hope that the group found the time valuable. As I mentioned on the onset, we're going to be looking to hold these webinars on a biannual basis. So if there are any specific sections discussed today that you'd like to review in more depth, or if you'd like a copy of the desk, or if you want to talk about other data related to what Isaac or I reviewed that you'd want to see in future discussions, please do reach out to us to continue the conversation. And obviously, we hope that everyone has a great rest of their day heading into tomorrow's big FOMC decision. And we look forward to talking with everybody soon. Thanks, everyone.